What looked like a bear market rally has perhaps gained a little bit of proportion. Is this as good as it gets, or the markets are now seriously reacting to medical news and there is scope for markets to expand further? And are we at a sharpish kind of in turn, at least both on the medical front and at least in the market front? Now let's discuss all that and with much more with Shankar Sharma. And Shankar, a lot of opinion makers had classified you as bearish, but you're saying, look, I'm not bearish. I believe in seizing these opportunities whenever they come. And you saw one opportunity, I believe 2 weeks ago, when you publicly went on record and said that you expect a sharp bear market bounce. So what is your understanding now? Is this as good as it gets, or this rally has legs to perhaps expand a bit more?
But the first and foremost, only idiots think I'm a bear. As I've always said, I play both sides of the spectrum, and I like to believe that you cannot just be one trick pony and make money or survive in the market. So long-term survival depends on playing both sides of the trade. So, in February, I think we spoke, markets were not looking good. They continued to be bad in February, continued to be bad in March. On April 1, we went all 100% from being on the sidelines to 100% invested. In India, of course, and globally, we were middle of March itself. I tweeted about it. We went into virtually 80% invested. So we are riding this rally. Hey, we are not sitting it out. We are not feeling bad about it. We are feeling very good about it, Mukund. So that's the strategy part. To answer your question, whether the worst is over, I think it might well be for certain stocks in India. It might well be for certain stocks globally. To say and would have had bigger losses than just riding the 65% down market. So to answer your question, is the worst over? I don't think it's over for India as an economy. I think it's definitely over for certain pockets of the market. And it is definitely not over for other pockets of the market. And some of those pockets are not doing well today. If you are not doing well today, that itself is telling you enough as to where the problems lie. And I don't need to spell it out for you, Nikunj.
Okay, so Shankar, I'm asking very elementary questions here. What the current investor has two risks: risk of losing money and risk of not participating. So what is a bigger risk for an investor right now?
It depends on how you navigated February and March. So if you manage to contain your losses, everybody will lose in these markets. Okay, it's only how little you lost. If you lost very little, then you definitely have to be participating, and that's exactly what our strategy has been, because we lost very little in the big fall. So we went in because we had the firepower. But if you're down 30-40%, then you just simply don't have the guts to participate. So like I said, there are pockets in the market where the worst is over. So if you ask for Cipla, does it go back to the lows? Probably not. If it's for a handful of banks and NBFCs, I think the worst is ahead of them, not behind them. So, that's pretty as clear as can be, Nikunj, that, you will not have a uniform bull market. Or for that matter, I don't think we have a bull market at all. India has been in a bear market. This year itself, it has been the worst performing market, barring one market. When you have fallen vertically, you will have vertical rallies. You will have it. What we are seeing is a vertical rally. Overall, what continues to be a bear market for the last 2 years in India. Nothing has changed there. But you should play it. If you're smart, if you're nimble, if you're a hare, you should play it. I doubt if many people can do that. But if you can do that, there is no harm in getting into this rally. I think I can still see maybe another 4-5% upside to the markets from here on as well.
But do you think 7,500 will act as a big base for the market? Because that's the point from where markets have really made a comeback.
And liquid markets make comebacks. I mean, one law of market I can tell you right now, that vertical rallies need not be followed by vertical falls. But vertical falls will always be followed by vertical rallies. If there is one absolute law in this market, this is it. There are many other laws, but they vary. This law is a given. Okay? We've had a vertical fall. We've had a 35% fall in a matter of 30 days. What do you expect? Markets are not going to go down 50% from there on. They will have very sharp corrective rallies, which is exactly what we are seeing right now. I don't want to read too much into it because I see a lot of pain ahead for a country like India. And those pains get papered over on days like this. But they exist. Job losses exist. Bank defaults exist. EMI is getting defaulted on exist. Those are real problems. That's not going to get solved by a 3,000 point Sensex rally. So markets are different from the real economy. The real economy is in terrible shape and it is not coming back in a hurry. It was already hurting even prior to the crisis, to the corona crisis. It's gotten even worse. So these rallies, we should play them, but we should not get romantic about them.
Okay. You always made this point, Shankar, that look, markets are separate, economy is separate. Yes, in the long term, we may talk about markets are a reflection of economy, but in the short term, those correlations do not exist. Since there is no IPL this time, let's talk about cricket terminology. In this market, where do you see, which are the pockets where you think one should bat on the front foot, and where do you think one should really avoid those pockets, and those are tough balls to really, handle?
Yeah, so what is to be avoided is very straightforward. Again, on January 1st, we tweeted that banks were a crowded trade and everybody, obviously believed that they would continue to be so. Normally, this can continue, but, they have collapsed. And they have collapsed for a very, very valid reason. And let's set the better for the NBFC, which are the stepchildren of the overall lending business in India. So, what is going to happen for banks or any other kind of lending company is that you're going to see a large-scale cut on your asset values. I mean, you can take any number. In a good time, you're lucky if you get it with 5%. In these times, you're looking at 10, 20, 30, 50% cuts on the quality of your assets. When you have that, you have net worth wiped out several times over for a number of financial institutions. And that is the reality. I mean, it's not, if you don't see that, then I think you're just simply not reading the data. So if that is true, then that's very obviously the space to avoid. It will again have sharp rallies because a leveraged play will always rally quicker than an unleveraged company. But that's not the area at least we or I want to be positioned in. So there are other pockets of the market. We like chemicals. You can see the screen today. They're all doing phenomenally well. There are other areas alike to those kinds of sectors. They're doing well. We will stick around there. We will not get brave right now. So to answer your question on this is a market to play in the V. This is not the market to play square of the pitch shots.
Fair point. Shankar, would you add pharmaceuticals as well to the list of preferred buys right now? They seem to be in the limelight for the right reasons, at least so far. Again, a very fluid situation. You don't know how the equation with US is going to pan out, but a trading rally and a very strong one nonetheless.
Oh yeah, so we have a lot of pharma, in our portfolios. We are playing this as well as can be played. And remember, it's not just about India. Globally, too, pharma stocks have done very, very well in the last couple of months. So it's more a part of a global move towards pharma because obviously when you have disease, then you need solutions, and solutions can come only from pharma or even from testing and diagnostic kind of companies. And globally, those kinds of sectors have been doing well, including in India. So I don't see the Indian thing being any different from what is being played out, elsewhere in the world as well. It's part of a big global rally in pharmaceuticals. I think this will sustain because I don't think this problem of the virus is just going to go away, very quickly. This is going to take some time to go back to normalcy. I can't even see that far out. When things will really become the way they were in January, right? At least I don't know whether you guys see it. At least I don't see it. So everybody will be trying to find a vaccine or, cure, etc., which means there will be news flow from the sector. News flow is good for this sector. So it's a very good space for sure.
Right. What would you avoid then, Shankar? What do you think is not going to be able to resurrect itself in a hurry?
Well, I just said this, that, Aisha, that, anything with leverage, you want to be absolutely away from. In exactly the same thing that happened in 2008. So basically what fell were the banks, what fell were the infras, because those two had leverage. Autos also fell, but they recovered because, autos usually don't have leverage. Right now, obviously banks you don't want to be in, you don't want to be in industrials, you don't companies. You don't want to be in, even I would say, mutual funds, because, those kinds of businesses, as somebody was telling me yesterday, that a lot of SIPs are getting cancelled because people don't have, their salary checks. So imagine this is like a domino effect for anything to do with finance. So, your EMIs will get defaulted on, your SIPs will get cancelled, your bank loans will get defaulted on. I mean, that is the reality. I mean, I don't want to sound alarmist, but, talk to people, you will hear pretty much the same thing.
I was just going through your tweets, and the last one says, asset allocation sahi hai, baki sab dimag ka dahi hai. As humorous as it may sound, but what's the rationale behind this one?
Well, I mean, if you just look at this year, Ayesha, I mean, gold has done so well. Government securities have done so well. Equities have been terrible. But the problem is, people just keep parroting one simple line, equities. That they are good, but they're not always good. And if you're truly interested in preserving your clients' assets and clients' wealth, then please start talking things which are away from equities also. I know we have all vested interest because we all get paid more when people buy equity. That is all our biases and vested interests. But at some point, you have to think about the client also, right? So if you think of the client, then you need to advise them properly as to the pie chart cannot all be equity. I mean, and that is exactly what has come through this year. It doesn't come through in a hot roaring bull market, but in situations like this, you end up seeing the value of that. I mean, one of our funds is up 3.2% this year. I mean, at least, it's not up 25, but it's up 3.2 against the market down 25. We will take that. That's exactly what I'm saying, that you need to get asset allocation right. Otherwise, you're always at the vagaries of a bull market, bear market. Most investors don't have the skills to navigate, such situation. Even professionals don't have the skills. You've seen the numbers from all mutual funds. I mean, down 30%, down 32%, 29%. When you as professionals cannot manage this, how do you expect a retail investor to get into equities and make any sustained money? So, at least think of that guy once in a while.
Sure. So, Shankar, are you saying that Indian investors, it's high time they should look at gold, real estate, other asset classes? What would you recommend they asset allocate in? What should the pie look like for Indian investors right now?
So, well, in India, unfortunately, the choices are relatively limited. But of course, then you know what not to do. I'm not going to be buying any corporate debt. I'm not going to be buying any real estate plays or real estate debt. Those two are out, which leaves you with basically a pie chart which has equity, which has gold, which has government security. How you go within this is really up to your skills or your fund manager's skills or your advisor's skills. But broadly, that is the pie chart. And if you look just this year, the other two pieces of pizza have done very well. And then gold, in my view, given the outlook on the rupee, which I think doesn't look particularly strong, gold by natural extension looks very, very good. If rupee goes to 80. Gold is looking good as it is in dollar terms and even better in rupee terms.
Shankar, but if one looks at the world interest rates are almost zero. Indian bond yields are still at 6%. So some would say that if somebody does not want to take risk, forget getting the bottom right or catching the rally right. In a world of zero interest rates, if you're getting 6% in bond yields, and when inflation is going to remain low, at least in the foreseeable future, I mean, it's a no-brainer that you should have large allocation towards, government securities.
Yes, and which is exactly what we have had, and we have done very well. I know having G6 in our investments. They've been very strong this year. I still see room for rate cuts. India cannot still afford 6% rates when the world is like at zero or minus. So there is still a gap that India needs to close. So when you see that coming down, obviously your G6 look good. But definitely debt doesn't mean corporate debt, because you can see for yourself, Nikunj. I mean, which company's debt would you want to buy today? Right? It's a terrible corporate debt market right now, and I don't see that changing. It just keeps getting worse. So the only safe haven there is at least bet on Government of India, such as it is, but at least bet on that, on their debt, rather than bet on the debt of sundry corporates. And I'm not excluding anybody from this list in terms of corporates. I think everybody is at risk in this kind of a meltdown situation. There is no corporate that is immune to this. No corporate with debt is immune to the problems that are being experienced and will go out in the future as well.
It's only when the tide, turns, Shankar, like Buffett says, that we'll find out who was swimming naked. Okay, Shankar, a couple of follow-up questions.
Sure.
The positioning of the market is such that mutual funds or fund managers currently are extremely overweight financials, and they've got it right for last 10 years. Now the underperformance starts, which means reallocation will happen. Whatever overweightage markets have in financials, which is a combination of private banks, NBFC, insurance companies, that's hurting them. So if a large overowned sector starts underperforming, what will happen to the allocation? How will things move? Because 40% in financials in this kind of a market is an absurd positioning for anyone to have.
Yes, but one thing I'll guarantee you, very, very few people will see it that way. Most people will go down with the ship. That is the law of this market. Because we always believe that we are right and the market is wrong. So something that was 2,000 is now 800. You will say that's a great buy, because now earlier it was, whatever, 5-8 time book. Now it is 4 time book. That's cheap. And I have said this repeatedly with you on your shows over probably a couple of decades, that book value in finance is worth zero. It means nothing. It's just a piece of paper with a number written on it. That's it. It can evaporate. I mean, to give you an example, what was Yes Bank's book value when the stock was 1,500 rupees? Maybe 300, something like that, 200, right? Where did that go? So you bought Yes Bank at 600 thinking, hey, it was 5-time book, a 6-time book, now it's 2-time book. That book is a mythical figure. It's like the unicorn. It just doesn't exist. It exists only as long as times are good. Moment it goes, in times are bad, it will evaporate. Even today, for example, Yes Bank, and which is what concerns me even more, okay, is that the scale of recap that has been agreed upon previously, which was before the corona, right? That happened before the deal that the government stitched together. I thought it was a very, very good deal to get SBI and the private sector lenders, but that was before this crisis. Now, are you adequately funded in light of this crisis? Is the financing adequate? Right? So those are questions which have to be answered. It is a company which still a significant size loan book, if I'm not mistaken, 2.5 lakh crores. In light of where we are right now as an economy, is the original funding of maybe 20,000 crore adequate? Does it need more? If it needs more, who gives it? SBI's own market cap is what, I don't know, 1,50,000 crores. How long can it keep, putting capital into any other kind of bank or bailout situation? So, being overrated financial is one thing, but you have to recognize it. I mean, there's another company from Jaipur, a Rajasthan-based NBFC, and that was trading 12-time book value. People are saying now it's cheap because it's 5-time book value. I mean, you've got to be nuts. What do you know about these companies? I mean, they are good in good time. Moment they turn bad, you don't know what kinds of things that keep coming out. Even in good banks, they come out. Forget about, some NBFC sitting and doing God knows what kinds of crazy loans. So we have always been clear about it that banks still okay, some of them. NBFC strict no. So far, we have not had cause to regret that particular view. So, but people will not see it for what it is. People will still go down with their drums beating, saying it's cheap, it's cheap, it's cheap. So people bought QIP for Yes Bank at 80 rupees, right? I mean, why forget that recent history?
So, Shankar, you always tape reader. I've always admired this about you. You said, look, I don't care about P multiples, I don't care about valuations, I am a tape reader. What is the tape telling you? Not about India, but in general about the world.
Yeah, so the tape told us in the middle of March there's a pretty decent rally coming up. And like I said, the only truth I have known my years of investing and trading is that vertical falls are always followed by a vertical rally, which is exactly where we are right now. I'm not getting romantic about it or anything of that sort. I'm playing it for what it is. Tape told me it was a great buying opportunity, and we have bought, we have held, we are carrying on. I think it will still run for some time. Okay, it's not going to get over like in 2 days or 5 days. I think probably even it can last a month or something like that. I don't think for India it is out of the woods kind of a market. For some stocks, as I repeat, it's out of the woods, but not for your 40% of the index. That's still a very, very troubled spot. So pick your spots well. Don't start getting romantic about this. View it for what it is. It's still a bear market rally. Make no mistake about it. But within that, there are good spaces you can play it and make money.
Shankar, you're a foodie, and I wonder, a foodie like you, how are you coping this kind of in lockdown?
So I am stuck in Delhi. Don't ask me why, but I'm here, and I was telling Ayesha, she was saying do a video call. I said I've not shaved for several days. I'm looking like Omar Abdullah. So I will just do a phone call. So yeah, so it's been actually pretty good fun. But for me it's nothing different. I usually work from home. I rarely go to office. So for me it's really nothing very different. Very, very organized to work from home, for sure. And the other good thing is that most people are getting more work done from people when they're working from home because commuting times have gone away, etc., etc. So most of our people are putting in 12, 14 hours of work, which ordinarily would be like 9 or 10 hours of work, which is another big thing that you will see in the future. Most people will realize you can do with far less people and you can do with far less office space, right? So, those are the imponderables that will unfold as we go down this, journey.
Shankar, we're trying to ask everyone perhaps a question on similar lines, which is that what are the learnings and what are the productivity gains and what are the best practices or knowledge you've learned and you would like to share when it comes to this work from home environment? What would be that learning? What would be that one thing you would like to share with our viewers?
I think it's terrible from a personal life perspective, for sure. You put in far more hours than you would put otherwise. But, it is nothing that your phone is your office. Really, the concept of office is very outdated, and I believed it for several years, not just today. You carry your phone in your pocket, and that's your office in your pocket. I can do pretty much every single thing on my mobile phone, which why do you need an office and a cubicle and a desk space for that? You can get a virtual assistant who will do your work sitting in the Philippines. You can do shorthand, anything. So, hey, I think it's just great. I think it will, like I said, it will expand people's thinking to start to think that, hey, why do I need everybody sitting in one central place? Let people work from home. We'll get more work done. It's cheaper for them, better for them. They're staying with their parents, etc., etc. And need for office space, I think, is a problem. I think people will realize you don't need so much commercial space anymore. And that was a hot spot, or rather the only bright spot in Indian real estate. Think about what happens to that.
Well, that's a point we've been discussing. All right, Shankar, enjoy your stay in Delhi. Certainly hope to see much more of you going forward. And next time, Shankar, shave, no shave, let's do a video call.
Sure, done deal. Thanks, guys.
All right. For a moment, let's take a break. Thank you very much.